There's a question many people are quietly asking right now. The markets look calm, stocks aren't crashing, financial headlines sound measured, and yet everyday economic life feels tight. Bills feel heavier, spending feels constrained, opportunities feel narrower. So, what explains this disconnect? How can markets appear stable while the broader economy feels under pressure? The answer lies in understanding that markets and the real economy respond to different forces on different timelines. When people say markets are calm, they usually mean major stock indices are stable, volatility is relatively low, and there's no visible panic. Markets are not euphoric, but they're not distressed either. This creates confusion because historically, market calm has been associated with economic comfort. However, that relationship has since weakened over the years. A lot of times, people, especially wealthy people, tend to mistake the real economy for the stock market, but it's not. The real consists of things like wages, employment, housing, etc., and it's often shaped by cash flow, not valuation. People experience the real economy through paychecks, bills, rent, and everyday prices, which are slow moving, sticky variables. Markets, on the other hand, are forward looking. They price expected earnings, future interest rates, and anticipated policy changes. They don't wait for conditions to improve, they respond to direction. If markets believe inflation is contained, rates won't rise much further, and earnings won't collapse. They stabilize, even if current conditions are tight. Households, on the other hand, don't operate on expectations, they operate on current income, current expenses, and immediate obligations. Forecasts don't pay bills, so even if markets expect improvement, households continue to feel the pressure until cash flow improves. That difference explains much of the disconnect. The role of interest rates in creating this gap. Interest rates affect markets and households differently. For markets, rates influence valuations, so expectations of cuts stabilize prices. For households, however, rates affect borrowing costs, refinancing, and credit card interest. And even when rate hikes pause, households don't feel immediate relief. This cost structure remains elevated. Asset prices are able to adjust quickly, while living costs adjust slowly. Once prices for housing, insurance, food, and services rise, they rarely fall. So, markets can price in stabilization, while households remain locked into higher costs. A critical distinction to point out is markets respond to liquidity while the real economy responds to income. Liquidity moves fast, concentrates in financial assets, and responds to policy signals. Income, on the other hand, grows slowly, spreads unevenly, and depends on labor markets. So, when liquidity stabilizes before income, markets calm before households do. Why corporate profits can hold while consumers feel pressure. Corporate profits do not depend solely on consumer comfort. Companies protect margins through pricing power, cost controls, efficiency gains, and workforce discipline that allows profits to hold, even when consumers feel squeezed. So, in other words, markets respond to profits while households respond to costs. Another lagging indicator is employment. Jobs may remain plentiful, but quality, mobility, and advancement are slow. That creates a paradox. People are working, but they feel stuck. Because when markets focus on employment levels, households focus on progression. Historically, market calm often coincided with economic ease, but today, asset markets have been supported by policy. The real economy carries higher fixed costs and debt levels are elevated. This creates an extended period where the two move out of sync. In earlier decades, policy actions drove markets. However, today, guidance often matters more. Markets move when future rate hikes are ruled out, policy tightening is framed as data dependent, and stability is emphasized. Actual economic relief may be months away, but markets will stabilize immediately, and households don't benefit from guidance. They benefit from cash flow, and so this gap sustains the disconnect. Why volatility suppression is intentional. Calm markets are not accidental. Volatility creates financial instability, credit tightening, and spillover risk. Policymakers actively work to prevent these outcomes, and so it leads to smoother market behavior, reduced panic selling, and narrower trading ranges. It does not mean conditions are easy. It means instability is being managed. Low volatility does not mean low risk. It means risk is being priced carefully managed through policy and distributed gradually. The markets are operating under constraint, just like the economy. They are calm because uncertainty is structured, not eliminated. Asset markets are adaptive systems. They reprice instantly, shift capital continuously, and respond to marginal changes, while the real economy is a slow system. Contracts, wages, rents, and services adjust over long periods. That time difference creates persistent divergence, the role of institutional investors. Large institutional investors dominate modern markets. They rebalance portfolios gradually, avoid panic moves, and focus on long term allocation. This dampens volatility. Institutional stability does not translate into household comfort, but it keeps markets orderly. Markets focus on earnings, not volume, and if companies maintain margins through pricing, cost control, and workforce discipline, earnings can meet expectations even as consumer stress rises. Markets reward predictability, and households feel affordability. These priorities diverge. Financial conditions indices may improve because credit spreads stabilize, equity prices hold, and volatility declines. But these measures don't reflect rent, insurance, food costs, and debt servicing. So conditions look better financially, but feel tight economically. Asset stability supports wealth, but only for asset holders. Those without significant assets don't experience portfolio relief, valuation gains, and balance sheet improvement. That's why calm markets don't immediately ease pressure for most households. As long as policy manages instability, earnings remain intact, and employment holds, markets can stay calm, even if households struggle. This phase ends only when income growth catches up, costs stabilize meaningfully, or policy shifts decisively. Until then, divergence persists. Why this disconnect is often misinterpreted. People often assume calm markets mean things are fine or tight conditions mean something is wrong. And both can be true at once because while markets measure risk, households measure cost. And understanding that prevents confusion. It's tempting to think calm markets are artificial, but what's happening is structural. Markets have evolved, policy is more proactive, participants are more institutional, and risk management is more sophisticated now, so this reduces visible stress, not underlying constraint. Reacting to calm markets by assuming ease leads to misjudgment. Likewise, reacting to tight conditions by assuming collapse leads to fear. Interpretation and understanding the mechanics is the correct response. This disconnects shapes public expectations, policy debate, as well investment behavior. Understanding it helps viewers make sense of mixed signals without jumping to conclusions. The gap between calm markets and a tight economy feels strange right now, but it's not permanent. The markets and the real economy operate on different timelines, not different realities, but eventually income adjusts, costs stabilize, balance sheets repair, and capital reallocates. When those processes reach a threshold, the two begin to move together again. The disconnect resolves not with a shock, but with normalization. The markets and the real economy realign through one of three paths. 1. Income catches up. 2. Costs stabilize. 3. Financial conditions loosen meaningfully. Most often, it's a combination. However, none of these happen suddenly. They all happen incrementally. That's why convergence feels invisible until it's already underway. Why income is the critical variable. Income growth is the bridge between markets and everyday life. When wage growth outpaces essential cost growth, job mobility improves, hours worked increase sustainably, and household pressure eases. Markets may anticipate this, but households only feel it once cash flow improves. That lag explains much of the frustration. Credit can play a key role in alignment. When borrowing costs stabilize and refinancing pressure eases, credit is used for investment rather than survival. Economic momentum improves, and this doesn't require cheap money, it requires predictable money. Employment staying strong is positive, but during this phase, it also masks stagnation. True convergence requires not just job availability, but wage progression and productivity linked income growth. Until then, employment stability coexists with pressure. Markets, on the other hand, don't wait for conditions to improve. They move when risk stops rising. Policy uncertainty declines and downside scenarios are avoided. That's why calm markets often appear disconnected. They are responding to direction, not experience. To understand when convergence is happening, watch structural indicators, not headlines. Discretionary spending funded by income, not credit. Business investment growth. Productivity improvements. Easing financial conditions for households, and stable wage gains relative to costs. These signals show alignment, not optimism. It's tempting to view this disconnect as dysfunction, but it's not. It's a result of proactive policy, advanced financial systems, and managed risk. The system is absorbing pressure instead of releasing it violently. That's adjustment, not failure. When people assume calm markets equals ease or tight conditions equals collapse, they misjudge the environment. This leads to premature risk taking, unnecessary fear, and poor timing. Understanding the mechanics prevents those errors. This phase rewards interpretation, not prediction or reaction. And interpretation means understanding incentives, reading structural signals, and recognizing adjustment patterns. Those who interpret correctly avoid extremes. The markets are calm because risk is being managed. The economy feels tight because cost and cash flow adjust slowly. These two realities are not in conflict, they are moving on different clocks. Markets being calm does not mean life should feel easy, and life feeling tight does not mean the system is failing. It means the economy is adjusting under constraint, deliberately, gradually, and without panic. Understanding this disconnect replaces confusion with clarity, and clarity is what allows people to navigate this phase without overreacting. While the system works through its adjustment,